Hello my fellow investors and welcome back to another stock analysis video, the second one for today guys. And this time we're going to take a look at the company SpartanNash. Now this one was brought up by once again Roberto CJ, and he pretty much wanted to know about this company. So we're going to take a look at this company based on its fundamentals and see if the current share price it is a buy. So with that said, let's get started with this analysis. So like always, let's take a look at what this company does, because I have no idea what it does. We got SpartanNash company distributes and retails grocery products, operates three segments: food distribution, military, and retail. And yeah, if we actually take a look back at the website, I kind of could have guessed that. But look at this. When it comes to retail, they have their own brands. We got Our Family, Open Acres, Nash Coffee, etc, etc, etc. So it's pretty cool overall. So yeah guys, this is a company that distributes and retails groceries. Now looking at their earnings, they announced it on November 9th, 2022. EPS normalized actual came in at 55 cents, which was a beat by 8 cents. EPS GAAP actual came in at 26 cents, which was a miss by 12 cents. And the revenue actual came in at $2.3 billion, which was a beat by $93.96 million. So now coming into the calculator, we got the ticker symbol for SPTN, market cap of $1.1 billion and a PE of 20.44 with a current share price of $31.56. And looking at this on the 1 year, it was actually up guys 22.8%, and on the year to date, they're currently up again 2.73%. 52-week ranges is $23.76 to $37.75. They do pay out a dividend of 84 cents per share, which is a yield of 2.66 with a payout ratio of 37.39% and a 5-year CAGR of almost 5% with 12 consecutive years of dividend payments. Ex-dividend date passed as of December 8th. Payout date was on December 30th, and they pay their dividends quarterly. Now based off of the current shares outstanding, this means that with 84 cents in annual dividends per share, they pay out $29.74 million in dividends every single year. And looking at this in regards to the cash flows, based on the 5-year average free cash flow after this is paid, they're still left with $62.3 million. And as of their last year's free cash flow, it is negative $95.84 million. That is not good. Seeing that, well, for starters, the fact that last year's free cash flow is less than the 5-year average means that their cash flow went way down last year. That's not good to see. And in fact, if we take a look at these payout ratios in regards to the free cash flows, we can see that as of last year's free cash flow, it is at a negative 40, essentially negative 45. And when it comes to the 5-year average, they're still at 32.31, still good, but that negative last year's free cash flow is really hurtful in my personal opinion. So now let's actually come over here and take a look at these fundamentals, starting of course with net income 5 years ago, 33.6 million to $56.1 million, which is an increase of 67%. Now the thing here is that it's just all over the place, right? You see here 5 years ago, $33.6 million to 4 years ago, $5.7 million. This is a massive drop. And then 3 years ago during COVID, it just spiked up massively. Probably because a lot of people were buying stuff in grocery stores, right? I mean, grocery stores were being cleaned out. We all remember the toilet paper shortage of 2020, right? At the beginning of 2020. That was hilarious. The memes that came out of it was just amazing. But then after COVID, you can see they just slowly went down year over year. That's not good to see. So the fact of the matter is that because of COVID, they did that good. And now that COVID isn't here, unless we get like another, disaster, they're going to keep going down. That's not good, guys. So overall, I'm going to give this like a 30%. Looking at the free cash flow, this is the one that we saw it to be negative. And boy, is it negative. We got 5 years ago of $99.9 million to 1 year ago of negative $66.1 million, decrease of 166% with an average of $92.04 million. Once again, we see the peak 3 years ago, and 1 year ago, guys, it just completely collapsed. It was just really bad. And on top of that, this isn't a case that their capital expenditures exceeded their cash from operations. I mean, I guess you could say it did, right? Their capital expenditures did go up from what, 79.4 to 90.8. Right? Okay. Yeah, it went up. But take a look at this drop when it came to the cash from operations. At the peak 3 years ago, it was $306.7 million. Then it went down to 161, and then it just completely crashed. $24.7 million in cash from operations. really bad, guys. Really bad, because I mean, if they would have just kept it at around like the $160 million mark like they did 2 years ago, then this right here would not be negative at all, this free cash flow. So very concerning, and for that reason, guys, I have to give this like a 0%. They're not growing on the 5-year, and you can see that the reason for even 2 years ago their cash flow being this low, it was because of the fact that their cash from operations went down. Looking now at the revenue, we got 5 years ago of $8.1 billion, 1 year ago of $9.43 billion, increase of almost 17%. And unlike the other two guys, this one's actually looking fairly decent. You can see a pretty steady increase from 5 to 4 to 3 years ago. They went down 2 years ago, which is again surprising since COVID was 3 years ago, not 2 years ago. And 1 year ago, they exceeded even 3 years ago. So overall, I'm going to give this one like a 95%. In the assets minus the total liabilities, this one's actually looking really good, honestly. Currently, they're in the positive $780.4 million. As you can see, it is lower than that of 2 years ago. Basically, the one in today, guys, is the same number because they end their fiscal year in January. So we have to wait till the end of the month for us to get the trailing 12 months, right, in 2022, if that makes any sense. So yeah, that's the reason why I just did it, so that way the numbers actually make sense. But you could see that from 5 to 4 years ago, drop, but then from 4 to 3 to 2, and maybe to 1, it may actually continue to increase. I mean, they only need like $2 million just to match 2 years ago, so I think they might be able to do it. If not, it's not too bad in my personal opinion. They're still in the positive. Average total assets is $2.3 billion. Average liabilities is $1.5 billion. Doing this difference, we get $753.26 million. I'm going to give this a pretty good grade of like 80% or so. Into the cash flow minus the total liabilities. Now, this is not really surprising to see that as of 1 year ago, they're at their lowest and negative $1.6 billion in this difference. I mean, it did went negative in their free cash flow that year, but honestly, this graph isn't even looking that bad. I would have thought it would be a lot worse. You can see there were a couple instances of increase. Well, actually, only one instance of increase from 4 to 3 years ago, right? Negative 1.5 billion to negative 1.3 billion. But then it just kept falling down, and you know, it is what it is. So yeah, I'm not really sure what to put for this one, but we'll get to that in just 1 second. Average cash flow minus the average total liabilities, we get negative $1.4 billion. I'm going to give this at around like 30% or so, because I mean, they had one instance of it going up, and honestly, it really isn't that bad. Like, I thought it was going to be a lot worse. Into the shares outstanding now, the silent killer when it comes to investing. We got 5 years ago of 36 million shares to today of 35.4 million shares. That is a decrease, small decrease of 1.67%. Even from the previous year to the current year, it's another decrease of 1.4%. Now, funny thing here is that, well, they did increase it from 5 to 4 years ago by like, what, 400,000 shares or so. But then when COVID hit, 35.9 million shares, and then they kept it the same the following year. And then 1 year ago is when they bought back a little bit of shares, going from 35.9 million to 35.4 million. So okay, they at least have the decency to not increase shares here, though I really am curious as to why they increase a little bit here. Overall, it's not too big of a deal. They're still buying back. I'm going to give this like a 90%. And when it comes to the cash and equivalents, they currently hold $19 million with an average of $18.02 million. Now, when it comes to the overall grade, unfortunately, this is not looking too good. Net income, we gave it 30%. Free cash flow, unfortunately, 0. Revenue, 95%. Assets minus liabilities, 80%. Cash flow minus liabilities, 30%. And the shares outstanding of 90%. For an overall grade of 50%. The biggest issue with this whole entire company is this free cash flow. It's all over the place. It's just not good. The fact of the matter is that 1 year ago, they felt not because their capital expenditures was higher than the cash from operations, it was because their, let's face it, cash from operations collapsed, and that is a major problem. That's the main reason why I gave it a 0, guys. Again, that's not something you want to see. Remember, every investment is the present value of all future cash flow. If you got decreasing free cash flow and they continue to do a decreasing free cash flow, that's going to mess things up for you, the investor. So 50%, guys, it's halfway there. If they fix their free cash flow, this would be pretty good at around like maybe high 60s or so. But if you're still interested in purchasing this company, even though I gave it a 50, you guys might give it different. I'll tell you guys exactly how to do that in just 1 second. But now let's actually take a look at the discounted free cash flow to see if at the current share price of $31.56, this is looking like a buy. So let's see what we get when we input the revenue growth, predicted share buyback, and the required rate of return. Obviously, right now, with nothing inputted, guys, we got, not adjusting for debt, $29.32. So fairly close to this number. However, adjusting for debt, it does fall a significant amount to $7.54, mainly because they do have a ton of debt. So let's come over here, Seeking Alpha. The revenue forward is estimated at 1.94, so essentially 2. Now, I'm going to be fairly conservative when it comes to this. I'm going to say 1% for the low assumption, 2% for the medium, and then 3% for the high one. And in regards to the predicted share buyback, I'm going to say the exact same thing. I'm going to go with 1, 2, and 3%. And now with that, guys, we get the target share prices, not adjusting for debt, $30.69 to $33.61. And then adjusting for debt, unfortunately, it comes down to $8.69 to $11.16, with a margin of safety of 5, 10, 15%. The lowest one in this case would be $7.39 to $10.60. So you guys can clearly see, adjusting for debt, this is the no buy right now. Not adjusting for debt, maybe, right? I mean, let's face it, what's the difference between $30.69 and $31.56? Like almost $1. So in my personal opinion, if you guys are looking at this and you guys don't care about the debt situation, then by all means, you know, this is looking like a pretty good buy, not adjusting for debt. Remember, the way that we adjust for debt is we take the net debt, then we add the cash and equivalents, and then we put that into the market cap that the calculator comes up with. That's why if this number goes down, then that means that their net debt is higher than that of their cash and equivalents. So this is the reason why this is occurring this way. Now, I personally do not like this company as it currently stands. I mean, I kind of just stopped paying attention after we saw the free cash flow graph. That's just mainly the way that I do it. It's just like, okay, if I see something that's like a major problem, like the free cash flow, I just stop there. I don't waste my time anymore. But if you guys still like it, you know, this is the 10,000 foot analysis for this company. Please do your own due diligence now if you do choose to continue with this company, because again, this is not financial advice, and as I said, every investment is the present value of all future cash flow. So please have this calculator. The link is in the description below. It's called All Calculators Video. You guys can go on to that link. It sends you to a video that I explain where to find all these calculators and even how to input all the numbers. So please have it for free. Make your own assumptions. Do not follow what I am doing. And I also have a book value calculator, a reevaluation calculator, and a dividend tracking sheet for everybody to have. I have all of this available once again for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help here with the algorithm on YouTube. I also would like to plug in my second channel. Now, I don't have any sponsorships, but I normally like to plug in my other stuff. In my other channel, guys, I make music videos, to be specifically game music videos, animated music videos, and maybe in the future movie music videos. And I just put out a video with the song New Divide by Linkin Park with the anime Attack on Titan. So if you guys are a fan of Linkin Park or Attack on Titan or both, or you guys just want to check it out because you've never heard of it before, I will leave the link in the description below as well to that video. So if you guys want to check it out, you know, stop by, drop a like, watch it, and tell me what you think in that comment section. Again, giving everything for free, guys. Just help me out with that. And of course, like, subscribe, comment, and share here on this channel, so that way we can continue to grow and make an awesome community. Now let's actually take a look at this dividend, guys, because with 84 cents per share, I mean, it's not really that big, and the discounted free cash was telling me that it's not really that good. However, let's entertain this, right? Monthly income, $5,725. We put all of this into this company. This gives us an annual dividends of $152.38, quarterly of $38.10, and a monthly of $12.70. So even this still to me is pretty subpar for what you're getting. On top of that, guys, the grade's at 50%. So all in all, I do not like this company, mainly for the fact that their free cash flow is really, really bad. And again, if it was just the capital expenditures being higher, I would give it a pass. But it's not. It's the cash from operations going down. That's my personal opinion on this. Thank you so much for the recommendation, Roberto. And that pretty much is it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. As I said, you guys can follow me on my music sites. The link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.